Gold and silver are supposed to be the safe corner of the market. On one brutal trading day, hundreds of billions in precious metal value vanished in under 2 hours. Years of gains disappeared on screens before most people finished their commute. Prices did not just drift lower. They dropped in a straight, near vertical line, as forced selling hit a market with almost no visible bids. The real story is not just panic. It is how the system is wired, who holds the levers, and who quietly scoops up metal after the crash. You are not supposed to see a safe haven move like that on your screen. You feel this even if you never bought a single coin. Governments hold part of their reserves in gold, so a sudden crash changes how solid their balance sheet looks to lenders and rating agencies. Miners and refiners see project economics flip overnight, which freezes hiring and investment in producing regions. Households in countries where gold or silver double as savings watch what they thought was a safe store of value behave like a high beta tech stock. When metals fall at the same time as equities and other risk assets, it tells you something uncomfortable about stress in the dollar system the whole world depends on. So the question is simple. Is this just fear, or is the market built to break like this when you need it most? A move like this only makes sense once you see how the structure actually changed. First, metals pricing shifted from slow physical trades to standardized futures contracts on large exchanges. That helped miners and manufacturers lock in prices, but pulled in speculators who never planned to touch a bar of gold. Later, electronic and high-speed trading took over. Algorithms started moving prices at machine speed based on order flow and volatility, not on slow negotiations between buyers and sellers. By then, you also had metal-linked funds and structured products that tracked the same futures-driven benchmark. Today, a huge share of gold and silver exposure lives in paper claims whose value hangs on what happens on a few big venues. Each step made hedging easier. It also made crashes sharper once too much leverage piled up in that paper layer. So, how does a market like this actually break in real life? Start with a strong rally. Prices grind higher for weeks, and traders use borrowed money to bet that the move will continue. Open interest in long futures positions climbs as more leverage enters the system. Then exchanges raise margin requirements, which means you suddenly need more cash to hold the same exposure. Some leveraged longs cannot or will not post that extra collateral, so brokers start closing positions automatically. Those sell orders hit an order book where market makers are already stepping back because volatility is spiking and they do not want the risk. At the same time, dealers who sold call options earlier in the rally now have to cut their hedges as prices reverse, so they dump more futures into the fall. Here is what is really going on. Crowded bets, tighter margin rules, and vanishing liquidity turn a normal pullback into a long squeeze that feeds on itself. We will come back to that pattern later because once you see it, you start spotting it everywhere. Behind those mechanics are a few very clear power centers. Futures exchanges and clearinghouses control the rules on leverage and margin. They decide how much pain the system can take before forced selling kicks in at scale. Large banks and hedge funds treat gold and silver as one more dollar-denominated collateral pool alongside bonds, equities, and derivatives. When stress hits somewhere else, they may dump metals to raise cash, even if nothing changed in the mine supply. On the other side, you have central banks and state-aligned buyers, especially in parts of Asia and the Middle East, that think in years and decades. They hold cash reserves and often prefer to add to gold positions on weakness. The basic tension is simple. When conditions flip, the leverage players have to cut risk fast. The patient reserve builders just sit and wait for those forced exits to show up. So who actually comes out ahead when a crash like this hits the screen? Cash-rich central banks and large physical buyers get the chance to accumulate metal at lower benchmark prices. Exchanges that ride out the volatility reinforce their status as the place where the world sets the reference price for gold and silver. On the losing side, leveraged traders and some funds see positions liquidated at the worst possible levels, locking in losses instead of choosing to exit. Mining companies and suppliers face whiplash in cash flow and project planning, which hits workers and local economies in producing regions most directly. Households who saw metals as a one-way safe haven get a harsh reminder that in this structure, the screen price follows the leverage, not their story about safety. If this kind of breakdown helps you make sense of gold, silver, and the wider system around them. Subscribe so you don't miss the next explainer. This is where the system stops being abstract and hits everyday life. In countries where families buy small bars or jewelry as a form of savings, a sharp crash can change decisions about education, migration, or retirement that were partly tied to that metal. In mining regions, companies delay expansion, cut overtime, or freeze hiring when price volatility makes long-term investment too risky. For governments, repeated violent moves in gold pricing change how confident they feel, putting gold in front of creditors and voters as part of their reserves. In global financial centers, each extreme move chips away at confidence in metal-linked funds and structured products that promise simple exposure to a complex underlying market. This is not just something that happens on a chart. It reshapes how people and institutions use metals at all, sometimes for years. Most explanations on social media go off track right here. People love to say there is one secret group scripting every metals crash from a control room. But when you look at the data, you see the same things over and over again. Crowded positions, margin changes, thin liquidity. Once the move starts, the system lets a lot of different players all push in the same direction. You also hear that strong physical demand means prices cannot fall far. In practice, the price is set where leveraged contracts trade, not at the jewelry counter. Physical buyers often step in after the forced selling has already driven the benchmark lower, which is exactly when long horizon players prefer to add to their holdings. If you only look for a single villain, you miss how the rules and incentives keep recreating the same pattern. So here's what is really going on with this crash. Gold and silver do not crash just because people suddenly change their minds. They crash because a leveraged paper system, run through a small circle of venues and institutions, turns stress into a chain reaction that hits the screen price first and the real economy after. If you want a simple field guide for next time, there are 3 things to watch. Strong rallies built on rising open interest and obvious crowding on the long side. 2, fast jumps in margin or collateral demands on key exchanges while volatility is already picking up. And 3, big shocks to dollar liquidity or interest rate expectations on days when positioning is stretched. When those 3 line up, the system is set up for another violent reset in the metal's price and another quiet transfer of metal from short-term traders to long-term holders. That's the story. Stay curious.